do 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 do. All right, guys. DCP, the New York Stock Exchange. Got that one from stageanalysis.net. And all right, no further ado, let's jump right into it. Let's see right away if we're losing our time with it, because we want that higher trend. We want to see if the higher trend is going to go in our direction. And let's do it right away, guys. What is this going to look like? Where is my monthly defined resistance? And right now it seems to be right here. Right there. Tuck. And right now we seem to be breaking out, guys. Zoom, zoom. There we go. Move that just a little bit. And this is our smaller breakout pattern. Let's do another line. Patterns within patterns. And if we really want to take the least greedy target, that's the smallest pattern, breakoff pattern off the breakoff line. And check it out. All I have to do is arrow time. Add that right here. Tuck. Let's copy that. Add it to the breakout line. And so here's our implied measure move, guys. Add it to the breakout line. So if the July candles, like 2 weeks left, breaks above and close above, where's my alert? 41.95. So let's say 42. We have a monthly defined breakout, and the target is 49. And that's the most probable of these patterns right here. You might even want to lower that target 49 just a little bit here. 48, where there's this resistance here. This is what I call a wall. Previous support, breakdown. Now that support has become resistance. So sometimes you want to do what I call profit target considerations and just lower the target. Just make sure you're on the right side. But this is looking A plus. Guys, let's zoom in on the weekly. Let's see what's happening there. And see our Stan Weinstein. All right, what do we need? Okay, this is my monthly defined breakout line. I'll leave it there. Could remove that. Remove that. That's my support. Monthly defined support. Don't need that. So just remember that. 42. That's my monthly defined breakout line. What do we need? Volume. Whoa, ho, ho. Look at that. Looking good here, right? What else do we need? Well, let's just start here. So where's my volume at? I need, and this today is only today's Thursday. It's gonna be posted Friday morning, so we might even have we're gonna get some more volume right here, guys. Is this twice the average volume of the previous 4 weeks? Looks like it. So Friday, tomorrow, that's probably gonna close just a little higher. Let's go over. We have 5 checks now. So if I take Stan's triple confirmation plus my 2 confirmation, well, it's actually a Stan confirmation, higher trend, and overhead resistance, right? So the higher trend, we did it. Check. Volume, check. We're down to 2. Breakout above a horizontal line and above the 30-week moving average. Here's my 30-week moving average. Check. So we're up to 3. So we have 1, 2, monthly 3. What else do we need? Ichimoku cloud. That's an add-on. We have to make sure that we're above resistance, the red cloud. And you see here's the green starting to go upwards. When the 30-week average is going upwards, when the price action is above the 30-week moving average, above the green cloud, you know you're in an uptrend. So that's my other check. My check 4. And what's the final check for the quintuple? confirmation is super duper important. Mansfield relative strength indicator. Yay. Wow. All right. So we're starting, guys. Mansfield indicator. Critical. Above the zero line. Right here. Zero line's right there. Right above it. What else do we need? Well, that's all we need. That's the triple. He wants the moving at the Mansfield relative strength to be above. So you want to be, oh, hold on. Let's configure that. So we have to, it's going to be against. This is a New York Stock Exchange. So the relative strength of the stock is actually a lot stronger. It's been a while that it's been outperforming the its index it's in. So that's super duper. Or the SP 500. Same thing. So it's been outperforming it for a while. But before, we didn't want to enter here when it's above zero because, well, maybe we could have, right? Remember this indicator, it has added value. It's highlighted green if the Mansfield is above zero, if the 30-week average is skewed upwards, if the price action is above the 30-week moving average. So this has even 2 additional checks just to make sure. There's so many. So we have 5. It's 30-week average skewed up. That's a 6th check. And the price action above the 30-week moving average, well, we did it here in this check here. So there's like 6 solid checks, right, that you have to go through and become automatics for you. Eventually, you just, and when you have all 6, it's like almost deciding for you, you know. You're buying your car. I want motor, speed, safety, tuck. This is my checklist. I'm buying a house. I want a pool. I want 3 bedrooms. I want check, you know. So same thing with stocks. If you want to be happy with the stock, if you want to uncover those, like Stan says, exceptional winners, then you have to wait for all these criteria to fit. Be patient, wait for them. Here I could check maybe eventually this one. You know, like I say, the initial breakouts, I trust more the second or third breakouts. But this one was above the 30-week moving average because it's green. We know that right away. We know that the 30-week average was angling upwards because the zone is green. Above the Ichimoku cloud, that's our check. Did we have the volume? Did not have the volume. There wasn't twice the average volume of the previous 4 weeks, guys. And that's one of the criteria we're looking for. We have not went in. The price action is below that monthly candle close here, so we would have not went in right there. But that's what I call those embryonic stage 2s. Okay, stock is giving potential. Somebody's starting to, the buyers are starting to work against the sellers. They're starting to go up, pull back, and now we're in. This is when to be in. You've proven that you're here to stay, guys. Stage 2. Let's test it. You're good to go. Let's do it again, guys. And then you explode. That's the story of the stock. This DCP stock on the New York Stock Exchange. That's its story. Relative strength versus index. Bounce off. Never went in negative territory. If it goes in negative territory, this becomes a red cloud, red zone. This is very, very healthy, guys. So you have a couple of choices. You could wait till the end of the week. Enter. Oh, get my pencil out. Could enter around here. I don't know where it's going to close tomorrow. You have the volume confirmation. And then maybe half a position here. Wait next week. The price action maybe at the end of the month is going to, well, I don't know what's going to happen. But I like, the price could always revert back in, guys. That's why you need the higher trend. I like confirming it with my classic chart trading framework. For some unforeseen reason, if the price action gets sucked back in and this becomes just a wick and the body closes below that breakout candle, not good. You want to avoid that. So if you're really, really defensive, you could take half of your percentage here, half of a percent risk, and then wait for the month close. And check it out, guys. Let's do something cool. Cool. Can I zoom upwards? Okay. I found this super duper cool tool on TradingView, man. It is awesome. It actually measures your risk. So let's say we enter this candle right here at this price, and then you put your sell stop wherever you want to put it. Usually you put it here. Traders, you put it 46% under the breakout line. Stan usually says rarely good stocks, they pull back more than 46%. And let's say you want to be extra safe, you'll say you put it all the way down here at 12-13% back down here. Now we don't know yet, but this is how you measure your risk to reward. So this is your risk. And what happens here, eventually the price action is going to start going upwards over time. And wherever you sell because your sell stop was hit because we moved it up, or your trend line violation or 30-week line violation, then this is going to actually tell your risk to reward. So you risk 1% of your NAV. And if the price you sell here and you won 3% of your NAV. So your NAV would have increased 3%. So let's say you have 100K. By the end of this move, whenever the price action gets all the way up here and you get triggered out, you would have made 3.3% of your NAV would have went up. And this is how the greed gets in, guys. You go here. Yeah, well, I want to make more than 3% of my NAV on this trade if I'm going to be in it for a year or so. And then that's when you get greedy. Say, Stan says 46%. There, I'll put it at let's put my sell stop at let's put my sell stop here at 6%, 6.19% off the breakout. It's not going to pull back there. And then you skew your risk to reward. You're close to 7%. So if ever that trade you sell up here, then your NAV would have grown 7%. So your 100K now becomes 107,000. And that's a pretty cool tool. I use that. Let's say we would have shorted back here. Let's say we would have shorted back here in the days. Let's do a quick simulation. Would have shorted right here. Do we have a trend line violation? One, 2, 3, 4. Or if you didn't want to count this one, if you didn't trust it, then you could have said like that. One, 2, 3, 4. Worst case, let's say, guys, you would have sold right here at the 30-week moving average violation, at the trend line violation. Remember pullbacks, price action starts going back down. You put a sell stop here the trader's way. Investors, pull back, price action goes back down. Traders, investors, pull back. Oof, you could have gotten close to getting triggered out here. Depends how. Remember, Stan says above the pullback, but also above a round number. And this you see didn't go. It stopped at 41.70. So if you would have put your sell stop at 42.05, you would have been okay. Trader's way, investor's way. Price action goes back down. Pull back. Price action goes back down. Here. Here. Same thing here. Pull back. Price action goes back down. Here. Here. Pull back. Price action goes back down. Here. Here. Pull back. Price action goes back up. Oh yeah, I keep saying down that. Pull back. Price action goes back down. Here, here, all the way down. Price action goes back up. Trend line violation, half your position you're out. Remainder half at the 30-week moving average violation, or that sell stop that's triggered right here. So it's a couple of things. If you miss out on the trend line, then you have your sell stops that are already there in place. So let's apply this, guys.
Okay, short position. Would have entered.
This candle right here. Or maybe this one. Worst case, you would have entered this one here. Sell stop. %46%, let's say 6%. Be safe. And here's your target. Oh, wait. Move it in time. And would have sold, let's say worst case right here. Your risk, your position size for this to be 1% of your NAV. Risk to reward, 7.4. So that's your NAV 100K would have been for this position would have gave you 7,400. And let's see how much time you had to be would have been in the trade. 462 days. So these add on, guys. So you don't have just one trade, right? You're risking 1% in the DCP. You're risking 1% in Apple, 1%. So let's say you have 5-6 open trades that span a year. That span 2 years. I've noticed that these big stages like that, they usually last more than a year. And you get to grab these 4%, 7, 8, 6, 7%. So if you have I don't know, 5%, 5 positions open, then you multiply that times 5 times 7. So that's 35% over 462 days, guys. That's not bad. And if you have even more positions, it depends also how tight you put your sell stop, your entry here. If you decided you wanted to put your sell stop just greedy, just on the top of the candle that broke down. So you say, look, if it goes back above the candle that closed below the breakdown line, I'm declaring this a fail. Then you could skew it in your favor more, but you're more vulnerable to pullbacks. Right here, you get closer and closer, get tighter and tighter, and that's how you play with it. That's when greed, when you start playing this, I call this greed. I believe you might have, it's better to have maybe more A++ setups and be a little bit more defensive here, not get triggered out. Because it's at the beginning, guys, it's like there's a hard retest of that breakdown line. And if you misidentified the breakdown line, and if it, let's say, was actually higher, you thought the breakdown line was here, but actually was higher, and then you get a retest higher, then you're just gonna get you're gonna get wiped out. It happened here that the retest was up here. It respected this breakdown line, but it could have very well been here, and you got in here and you thought this was the breakdown line, but it was higher, so the price action could have went all the way up close to the real breakdown line, and you would have got triggered out. You got to really stand. He has that 4-6% rule, but a lot of the times if there's a launching pattern, he's going to want to position the investors way below the low, or below or higher the high of that breakout pattern, just to make sure he survives the initial pullback. Pretty cool, guys. I wanted to show you that. I thought that was a cool add-on. I'm going to let you go for now. DCP, guys, check it out. By the end of the day, I think you could enter. And if you really, really want to wait for that monthly candle close in case some crazy thing happens and price action gets sucked back in within this breakdown line, guys. Breakout line. All right. See ya. Ciao.